Welcome to our video on default risk. This is part of a series of videos on different types of risk and how they can affect asset classes in a portfolio. So let's get started with some of the basics. What exactly is default risk? Well, first of all, default risk is also called credit risk. And basically, it's the risk that an investment will lose value based on the defaults of a credit obligation. So basically, in plain English, what this means is that if someone borrows money and then all of a sudden they can't afford to pay that money back, then they will default on their debt. They'll effectively write off the debt and declare the lender won't get their money back. And the probability of this happening is default risk. The higher the probability, the more default risk there is. Default risk is most commonly associated with what are called fixed income securities. Fixed income securities are things like bonds and certificates of deposit that pay out interest rates. Things like stocks and commodities. Stocks receive dividends, and commodities just kind of appreciate or depreciate in value. So they are not considered fixed income securities in the traditional sense. Now, default risk is also somewhat relevant to the valuations of those kinds of asset classes, but it is most relevant for the fixed income securities category. Default risk is largely driven by credit ratings, and these credit ratings are set by rating agencies, organizations like Moody's, Fitch, and Standard & Poor's. A low rating means a higher probability of default. I'll actually try to do a whole separate video on credit ratings at some point in the future, but that's the most important thing to remember right now. U.S. Treasury bonds have the highest possible credit rating. The United States government has never defaulted on any debt that they've issued. So their credit rating is considered AAA, and it's the highest, safest possible credit rating, and they are considered the safest investment. On the other hand, high-yield junk bonds are rated significantly lower. So now you're probably asking yourself, why would anyone buy the junk bonds if they have a much higher probability of default? Because the rating's a lot lower, right? Well, that's a really good question, and the answer is because they receive a higher interest rate. So again, going back to our original discussion on risk and return, the more risk you take with an investment, the higher probability you're going to have of an above-average return. That is the general rule here. The higher the credit risk, the higher the interest rate. So now that we understand a little bit about what default risk is all about, let's understand what are some of the things that increase the risk of default, or at least determine the risk of default. These are parts of the equation of probability of default. One of the most important factors is the financial strength of the bond issuer. And what I mean by this is, what is the ratio of assets to liabilities? If a bond issuer owns a lot of stuff and they don't owe very much stuff to other people, well, that's a good thing, right? Because worst case scenario, they can always sell some stuff in order to pay off the bonds. But if they have a staggering amount of debt and they don't own very much, well, the probability of default is higher. These are actually parts of a larger issue, which is called the capital structure of a company. And I'm actually going to try to create a whole series of videos about this topic later. But needless to say that the financial strength of a bond issuer is a very important consideration when it comes to default risk. Another important consideration is the ability to generate cash flows in the future. And this can be true for corporations, which generate revenues from businesses. And what are the expectations of profitability on these businesses, right? Because if a corporation is generating a ton of revenues, but they're also paying out a ton of money in expenses, they might not have any money left over to meet their debt obligations. So the probability of default will go up. So you want to look for companies that are profitable. Those companies tend to have a much lower probability of default. They tend to be safer investments. While companies that are losing money, well, those companies obviously are going to be much higher risk. It's actually the same things with governments, actually. If a government can increase their taxation to pay back bonds, well, that's certainly a good thing from a bondholder's perspective, right? Because a bondholder has the guarantee of the power of taxation. And when you should watch my video on municipal bonds, which will talk more about this. This kind of ties into my third point, which is the possibility of increased expenses. things are certainly getting more expensive in the world as inflation continues to increase. And this can range from things like the cost of raw materials for a manufacturing company to the cost of labor, which for many companies and organizations tends to be the single biggest cost. And as you have to increase salaries, pay people more and more, increase their benefits, labor costs tend to go up. So if these costs are going up much faster than the revenues, well, the probability of default is certainly going to increase. So now that we understand probability of default a little bit, let's take a look at a comparison of two different securities. We're going to look at high-yield junk bonds and certificates of deposit. And we'll try to understand how default risk plays into both of these securities. So let's start with the high-yield junk bonds. Let's say they're issued for a relatively unstable corporation, something like General Motors right now. As I give this presentation in July of 2009, General Motors is going through major restructuring in a bankruptcy. General Motors has great uncertainty of their financial position and of their future cash flows. So what this means is that their default risk is quite high, right? Because who knows what's going to happen with the company. And as a result, any investor who wants to buy General Motors bonds will demand a higher interest rate because they're taking on a lot more risk. So that makes sense, right? Certificates of deposit, on the other hand, are relatively stable investments issued by banks. A lot of certificates of deposit are also guaranteed by the FDIC, the Federal Deposit Insurance Corporation. And I actually created a video about this called Are Your Bank Accounts Safe? Which I recommend you watch if you want to understand a little bit more about certificates of deposit. But the point here is that these are relatively stable investments. They're guaranteed by banks at one layer, and then the FDIC is a government organization which guarantees them on a second layer of defense. So as a result, they are much safer than these high-yield junk bonds from General Motors. And as a result, they will pay out a much lower interest rate. So that's the big takeaway here is that default risk is driven by a number of different factors. But in return for taking on that default risk, most securities will pay out a higher interest rate. Thank you very much for watching, and for similar videos in the risk and return series and discussing different types of risks, I recommend you check out my website, www.kanjo.com.